What's up, you guys? It is Mrs. Invest, and today we are going to talk about the beautiful animal that is the TFSA, which is a powerful savings vehicle within Canada. If you are going to do your own investing, you need to know this account inside out and all the rules. We're going to go over everything today, from contributing, withdrawing, maximum limits, investing strategies, tax strategies, and a couple other things. So let's get right into it. So what is the TFSA? The TFSA is an account created in 2009 by the government to allow Canadians to put our money into and allow it to grow tax-free throughout our lifetime. Now, it's important to know the TFSA is an account and it's not an investment within itself. And within the TFSA, you can have cash, invest your money into interest-generating assets like savings and GICs. You can hold bonds, you can buy stocks, ETFs, mutual funds. The world is your oyster within the TFSA. And as far as investing goes, the term tax-free savings account is a little bit of a misnomer, because using the tax-free savings account to generate interest is not the best strategy. What you really want to have open is a tax-free savings account investment account. The reason is because savings accounts generally return you really low returns, usually below inflation or below 2%, meaning that if your money is in a savings account, it's actually losing money over time. So really the account should almost be called the TFIA, but wasn't up to me. So when you go to the bank, you'll ask them to open a TFSA investment account. And if you're watching this video, you're probably interested in doing your own investing. So in that case, you'll ask them to open a self-directed TFSA investment account. And when that account is open, that's what you can use to get started with investing within your TFSA. So what's so good about the TFSA? Well, normally, whenever you earn income in Canada, whether that's working or through investments, the government takes a portion through tax. Within the TFSA, any income you earn through your investments are tax-free. So all the returns you get can be immediately reinvested into the TFSA and allow that money to grow over time. And this really increases that snowball effect of compounding, because instead of a portion of those returns being taken away, you can immediately reinvest them in order to make more money. Sounds too good to be true, right? Well, let's just put all my money in my TFSA and then I'll pay no tax. Well, there are some rules, so let's talk about that. You might hear the term TFSA contribution limit. There are two limits that people are talking about. There's the limit that exists per year of how much money since 2009 that you can put into the TFSA each and every year without going over that yearly limit. The second limit is your lifetime contribution limit. That's the total amount of money you can put in the TFSA for you as an individual. Anybody born in the same year or whoever's the same age has the same total contribution limit within their TFSA. So in order to calculate your lifetime contribution limit, you add up the yearly contribution limits per year, every year since you turned 18. In this chart, you can see from 2009 to 2012, the limit per year was $5,000. 2013 and 14 were $5,500. 2015 was a magical year where it was $10,000. And you can see all the yearly contribution rooms from 2009 to 2020. If you turned 18 in 2009 when the TFSA was open, your maximum room would be $69,500. But what if you were younger than 18 in 2009? Well, what you have to do is add up the available yearly contribution rooms starting from the year that you were 18. So for example, if you look at this chart, if you were born in 1992, your room is $64,500. And the younger you are, the lower your contribution room is. If you turned 18 in 2009 when the TFSA was opened, your maximum contribution room in your TFSA is $69,500 as of 2020. Your maximum limit is also available on the CRA website when you log in, but that's only updated once per year when you file your taxes. If you're putting money in and taking money out throughout the year, then that's not going to be reflected on your CRA login, and it's really up to you to keep track of what's going in and what's coming out of your TFSA. And if you use more than one bank, you can have more than one TFSA account, but the sum of the total of all of those accounts cannot go over your maximum contribution room for you as an individual. And any growth of your money within the TFSA is yours to keep, and it does not count against your contribution room. So let's say within your TFSA, your investments made $10,000 that year, you can still put in the maximum contribution room for that year. So whatever your money grows is irrelevant to how much money you can put in. So let's talk about withdrawing money from the TFSA. This is a really important topic where a lot of errors are made, so let's spend some time on this. If you take money out of your TFSA, you do not lose that contribution room permanently. It just gets carried forward to the next calendar year. The general rule is any money you take out of the TFSA within a year, you cannot recontribute until January 1st of the next year. There are two specific scenarios when it comes to withdrawing money out of the TFSA. Scenario one is if you've maxed out your contribution room of your lifetime contribution limit and you want to withdraw money from the TFSA. In this case, whatever you've taken out, you cannot put back in until January 1st of the following year. So let's use an example. Hermione is 30 years old. She's maxed out her TFSA room at $69,500 in 2020, and she wants to take out $2,000 on March 1st, 2020 to buy a broomstick. She cannot recontribute that $2,000 until January 1st, 2021. On January 1st, 2021, she can contribute the available room for that year. Let's say it's $6,000, plus the $2,000 she withdrew in the previous year. So on January 1st, 2021, Hermione can put in $8,000 into her TFSA. The second scenario is if you haven't maxed out your lifetime TFSA contribution limit and you want to withdraw money. In this case, you can put money back into your TFSA within the same year only because you have contribution room remaining, not because you took money out. For example, Harry is 30 years old and he's contributed $59,500 of the $69,500 available for his age group, meaning he has $10,000 of contribution room available that he has not used. He also removes $2,000 on March 1st, 2020 to buy a broomstick. Not because he's a wizard, Harry, but because he still has contribution room left, he can recontribute that $2,000 he withdrew during the same year. The only reason he can do this is because he had $10,000 of room available. If Harry didn't withdraw any money that year, he would have been able to put in $10,000 because that's what he had available. But because he withdrew $2,000, he's only able to put $8,000 into his TFSA that year. Once the next year on January 1st rolls around, he will be able to put back in that $2,000 that he initially withdrew. If you're maxed out in your TFSA and you take money out and put that money back in the same calendar year, that's considered an overcontribution and you'll have to pay a penalty on that overcontribution amount. The penalty is 1% of the balance of whatever you've overcontributed. Now this can really add up, especially if you've made this error early on in the year, and that is allowed to accumulate interest for the entire 12-month period until the next year on January 1st. You have to keep track of any withdrawals, contributions, and your maximum lifetime contribution limit within your TFSA to ensure that you don't go over. So what about investing within the TFSA? Whatever you gain within the TFSA is yours to keep. But whatever you lose within the TFSA is lost permanently. You can't claim those losses as a tax write-off, and that contribution room is gone forever. If you buy a stock within your TFSA and it goes to zero, you lose 3 times. You lose the money that you initially put in, you lose the ability of that money to compound and grow over time, and you lose that contribution room forever. So losing money in your TFSA is pretty painful, because the room is so precious and you want to avoid it at all costs. High risk, high reward investments may not be worth it within this account because the room is precious and you don't want to lose it. And knowing when to withdraw is really important in the TFSA and otherwise. So here's a withdrawal tip. If you're going to take money out of your TFSA, do it near the end of the year, so around Christmas time in December, because that way you can quickly recontribute that money January 1st of the next year. If you take money out of your account on January 1st of 2020, let's say, you have to wait a full 12 months, 365 days in order to put that money back in on January 1st, 2021. So what should you invest in using your TFSA? Well, let me start by saying that a good investment is a good investment anywhere, but there are certain investing pearls that you can use to your advantage in order to maximize the benefit of your TFSA versus other accounts like the RRSP or a non-registered investment account. When it comes to what to hold in your TFSA, there's really 2 important factors to keep in mind. The first thing is, what return can I expect from this investment? And the second thing is, what are the tax implications of these returns if I were to hold them outside of the TFSA? Let's go through some of the common types of income that you can generate within your TFSA and talk about the pros and cons of holding these types of investments in your TFSA. The first thing you can have in your TFSA is cash. Now, this is a really good way to get nothing done, and unfortunately it's a really common misconception that if you just put money into the TFSA and keep it in cash, that somehow it's going to magically grow. One way to earn money in your TFSA is through interest. This is from a savings account or GICs. Because the rate of return through these types of investments are so low, you're not really making much money this way anyway, so although they're taxed heavily, you're not really saving much in tax. Another way to earn income in the TFSA is through capital gains. Now, whenever you sell a stock or an ETF for a profit, that's considered a gain. Capital gains are already taxed pretty favorably, especially at higher income levels at about 23%. And let's say you held a stock for 10 years before selling outside of your TFSA in a taxable account. Well, you wouldn't have been paying tax all of those years anyway because you would have been holding. So the tax would have been deferred regardless of whether it was in your TFSA or in a taxable account. Now, with that said, eventually when you do sell, if it was within your TFSA and you sold for a gain, that gain will be yours to keep and you don't have to pay tax on it. Another income source within the TFSA are dividends. If you are a shareholder of a company and you buy their stock, some companies will pay you every few months for being a shareholder. Usually this is every 3 months and it's paid out 4 times a year. At higher income levels, dividends are taxed a little bit more than capital gains at 29%. And each and every time that you receive a dividend, that is immediately a taxable event for that year. So that means at the end of the year, you will have to pay tax immediately on all the dividends that you've received that year. However, if you hold investments that pay dividends like stocks in your TFSA, you can immediately reinvest 100% of those dividends in order to make more money. Another income source you can have in your TFSA are distributions. Now these basically are similar to dividends, but there are some differences, and they are paid out by REITs or real estate investment trusts. Think of them like real estate stocks. And REITs generally pay distributions that are higher than your average dividend paying stock. And the tax treatment on distributions is much less favorable than either capital gains or dividends, meaning that they're taxed higher. So if you do want to hold REITs, they're a great thing to hold in your TFSA because the return is higher and the tax treatment is worse. So they're a good investment to shelter in a tax-free account. And I can't emphasize enough, the tax strategy should be secondary to focusing on good investments. A good investment is a good investment anywhere, and that should be your main priority. Then you can figure out how to optimize your investments for tax, but don't ever invest in poor quality investments for the purpose of tax savings. Okay, and I have to make a word about day trading and swing trading within the TFSA, and this means you buying and selling stocks either within the same day or within a short period of time over a couple days over and over and over for the purpose of generating a profit. Now the CRA has very vague guidelines about what they consider to be too much day trading or too much swing trading within the TFSA, and they've pretty much left it up to their own discretion to determine what is allowed and what is not. And things they look for are excessively high balances in your TFSA, the frequency that you're making trades, how long you're holding the assets that you're trading, and the amount of time that you're spending during the day trading. So if you are trying to play games in your TFSA in order to generate a profit, and the CRA audits your account and determines that yes, in fact, in their opinion, you were either day trading or swing trading excessively, then they will consider that to be a business and tax whatever income you made from those trades as business income, and you'll lose all the benefit of the TFSA. And so that's just something to keep in mind. Now the TFSA is a beautiful tax-free animal, but there is one investment that you will have to pay tax on if you hold in your TFSA, and that is if you hold U.S. listed assets that pay dividends. So if you buy a stock on the American market or the American exchange and it pays a dividend, you have to pay what's called withholding tax, which is a 15% tax on the dividends paid out by that asset. Now this comes off automatically from the dividend that you receive, but it does reduce your returns. However, you don't have to pay this withholding tax if you hold that same US listed asset in your RRSP. So if you're holding a large quantity of US listed assets that pay dividends in your TFSA, they might be better held in your RRSP because of the US withholding tax. Thank you so much for watching. I hope you found this video helpful. If there's any topic that you want me to go in a little bit more detail on, just let me know in the comments down below. And please give the video a like and subscribe if you want to see more topics related to personal finance, investing with a Canadian spin, and financial independence. And I'll see you in the next video. Bye.